If you've been tracking the markets this past week, you probably felt like you were on a roller coaster without a safety bar. What started as this incredibly serene, almost too good to be true climb suddenly shattered, leaving, well, a trail of questions. One moment we're hitting record highs, feeling pretty confident. The next, it feels like the floor just dropped out from under everything. So the big question on everyone's mind is what really happened? Our mission today is to do what we do best here at the Deep Dive. Cut through all that noise and confusion. We're going to unpack this market chaos by dissecting the precise events and the underlying data that triggered such a swift and dramatic reversal. We've been sifting through detailed market analyses, the latest economic reports, and critical geopolitical developments. Our goal is to provide you with a crystal clear understanding of exactly what unfolded, why it blindsided so many, and crucially, what it means for your financial world moving forward.
Yeah, this past week truly was a pivotal moment, a real turning point that highlights just how quickly prevailing narratives, even, deeply entrenched ones, can be upended. What felt like a comfortable, low volatility environment rapidly transformed into something far more uncertain. As we dig into the layers of this story, you'll start to see how incredibly interconnected forces are always at play in the global economy. This deep dive isn't just a recap. It's designed to offer you profound, interconnected insights into the underlying dynamics that drove this significant and, frankly, unexpected shift in market sentiment. It's about understanding the subtle currents beneath the surface.
Okay, let's rewind then. Back to the beginning of the week ending August 1st, 2025, because it started with such a profoundly different tune, didn't it? Picture this. A palpable wave of genuine optimism swept through the markets. The S&P 500 and the Nasdaq composite weren't just edging higher, they were notching their sixth consecutive record closes, one after another, early in the week. It truly felt like nothing could stop this upward momentum. And why such exuberance? Well, the news cycle was dominated by what seemed like incredibly encouraging developments on the international trade front. New, seemingly benign agreements were being finalized with key partners like the European Union, Japan, South Korea, easing a lot of the prior uncertainties that had hung like a dark cloud over global commerce. On top of that, the second quarter corporate earnings season had kicked off strong, right? Many companies reporting robust results, hinting at economic resilience. Investors were absolutely loving it. It was, in many ways, the perfect setup for continued calm and a smooth ride higher.
And yet, that placid, low volatility climb, which had defined the summer, didn't just stumble, it abruptly shattered in the final days of trading. What we witnessed was the market pivoting violently, a complete and decisive shift to what we call a risk-off posture. That's when investors basically shed their riskier holdings, things like high-growth tech stocks or cyclical industries, and instead pile into what they perceive as safer assets, often government bonds or more defensive stocks, utilities, consumer staples, that kind of thing.
Right, the classic safe havens.
Exactly.
Mhm.
And this shift culminated in a broad and incredibly steep sell-off that hit us particularly hard on Friday. The SIBO Volatility Index, often referred to as the VIX or the market's fear gauge, really told the story. It spiked by nearly 12% on Friday alone.
Wow, 12%.
Yeah, that wasn't just a flicker of fear. It was a definitive signal that the midsummer calm was emphatically over, and a new era of market anxiety and uncertainty had unequivocally begun. It was a dramatic change in character for the market.
And despite all those early week record gains, the late week turmoil was so intense, so broad, that it managed to push all three major U.S. indices into negative territory for the entire period. Think about that for a moment. 6 consecutive record closes and still a net loss for the week. It's pretty remarkable. The S&P 500, a key benchmark, ended down nearly a full percent. 0.8% to be exact, losing about 49 points to close at 6,339.39. The Dow Jones Industrial Average had an even tougher time, dropping a significant 1.7%. That's over 770 points wiped out, closing at 44,130.98. The Nasdaq Q Composite was a slight outlier, managing a tiny gain of just 0.1% for the full week, plus 14 points at 21,122.45.
It definitely did. It couldn't escape that Friday sell-off.
Now, to provide some context, year-to-date gains remained robust across the board. The market wasn't suddenly in bear territory for the year or anything like that, but this particular week, despite those early highs, marked a notable correction. And crucially, it introduced some very significant and unexpected headwinds for the month of August, signaling a potentially rockier road ahead. Now, to really understand why this dramatic reversal happened, we have to zero in on Friday, August 1st, 2025. That single day wasn't just bad. It was arguably the most significant single-day decline U.S. equity markets have seen in months. The sell-off wasn't just noticeable, it was broad-based and severe. We saw the S&P 500 fall by, what, 1.2% to 1.9%, depending on the exact measure. Its worst daily performance since way back in June.
Yeah, significant drop.
The Dow Jones Industrial Average shed hundreds of points, 451 to 600 points, amounting to over 1% decline. And the Nasdaq Composite, which had been the market darling earlier in the week, slid by 1.6% to 2.5%. It really bore the brunt of that selling pressure.
It did. The higher growth names got hit hard.
And the session started with futures pointing sharply negative, and critically, the indices failed to recover throughout the day, closing near their session lows. This is often seen as a key technical sign of strong bearish conviction. Right?
Absolutely. When you can't bounce back during the day, it shows the sellers are really in control.
And just like that, the S&P 500's impressive streak of record highs from July was officially broken, leaving investors reeling.
This dramatic shift, especially on Friday, can be traced back to what we're now calling a 1-2 punch of catalysts. The primary trigger, the first significant shock, was the profoundly disappointing July jobs report. The U.S. economy only managed to add a mere 73,000 jobs in July.
Only 73,000, wow.
Yeah. This fell significantly short of what analysts have been expecting. The consensus forecast was hovering around 100,000 to 110,000 new positions.
No, a big miss.
A big miss. That alone was concerning, indicating a slowdown. But what truly sent shockwaves through the market, what was far more alarming, were the staggering downward revisions for May and June.
The revisions, I saw those. They were brutal.
Brutal is the right word. Combined, these 2 months saw job gains revised down by a massive 258,000.
250,000 jobs just vanished from the previous reports.
Essentially, yes. To put that in perspective, this wasn't just a slight adjustment. It was the most dramatic negative revision in 5 years. What it effectively did was fundamentally recast the entire recent economic narrative. Instead of a picture of steady, resilient growth, which many had believed was the case, we were suddenly looking at one of rapid deceleration.
So the picture changed overnight, almost.
Pretty much. The revised figures showed May's job growth at a paltry 19,000 and June's at just 14,000. These are levels that are far, far below what's needed to simply keep pace with population growth, let alone signal a healthy expansion. Historically, such substantial downward revisions often signal significant economic turning points, suggesting that the economy in the second quarter was considerably weaker than anyone understood in real time.
That's a really worrying sign.
It is. And to compound the gloom, the unemployment rate also ticked up to 4.2% from 4.1% in June, which, whilst a small move, reinforced the softening labor picture. We also saw fragility in the report's components, like goods-producing industries contracting for the third straight month. Service industries tied to trade showed a marked decline too, likely due to tariff uncertainty already creeping in.
So it wasn't just the headline number, the internals were weak too.
Exactly. The market's severe reaction wasn't just about missing a single headline number. It reflected a sudden and sharp increase in the perceived probability of a near-term recession. This moved the risk of a downturn from being a fringe concern to becoming a central, immediate worry for investors.
So that jobs report alone was a massive hit to confidence. But you mentioned a 1-2 punch. Was there something else lurking out there that piled on to make Friday so brutal? Or was the market just hyper-focused on employment data? Because it felt like a complete U-turn from Thursday evening.
You're absolutely right to point that out. It wasn't just the jobs report. The market took a second, equally devastating punch, and it came in late on Thursday evening. The new U.S. tariff regime.
The tariffs. Okay.
This announcement effectively shattered all the trade optimism that had been fueling the market's rally for the earlier part of the week. You know how markets often buy the rumor and sell the news? Well, this was a clear sell the news event, but not because investors were just taking profits.
Right. It was more fundamental than that.
Exactly. It was because the specifics of the new tariffs were far more putative, far more widespread, and far more aggressive than anyone had truly anticipated. The market had seemingly priced in new agreements that would resemble something relatively benign, perhaps like the 15% tariff rate that was recently negotiated with the European Union. That seemed like a manageable, somewhat predictable outcome.
Okay, so expectations were maybe for something softer.
Much softer. Instead, the administration imposed tariffs, ranging from 10% to as high as a staggering 41% on dozens of countries.
41%. On whom?
Well, it varied. Switzerland, for instance, got hit with 39%. It was a much broader and more aggressive trade policy than investors had factored into their models. For instance, Canadian goods saw a hike to 35% from their previous 25%. There was a completely new 25% tariff imposed on India.
Wow. So it wasn't just tweaking existing deals.
Not at all. This wasn't just a few adjustments, it was a fundamental shift, a clear signal that the trade war narrative wasn't just continuing, it was intensifying dramatically. And this announcement created a dual negative impact that reverberated immediately through the markets. First, and most directly, it posed an immediate and tangible threat to the earnings and supply chains of countless multinational corporations that have exposure to these newly tariffed countries.
Right, imagine your costs jumping 30% overnight.
Exactly. That's a direct hit to the bottom line, and companies suddenly had to reevaluate their entire global operations, their sourcing strategies, their profitability forecasts. It throws everything up in the air. Second, and arguably more significant in a broader sense, it broadly injected a substantial new dose of uncertainty into the entire global economic outlook. This immediately increased the overall risk premium that investors demanded to hold equities.
Meaning it just got riskier to own stocks.
In essence, yes. The cost of taking on stock market risks suddenly went up because the future became far less predictable. The sheer breadth and severity of these tariffs signaled clearly that trade tensions were escalating, not de-escalating as the market had desperately hoped. This fundamentally undermined the positive narrative that had been supporting the market's ascent for weeks, particularly the belief that trade issues were largely behind us. It pulled the rug out from under that core market assumption.
With all that turmoil, the market's response was, as you said, a classic defensive rotation within the S&P 500. Investors weren't just selling everything indiscriminately, they were very specifically fleeing cyclical sectors. These are the industries like manufacturing, energy, or consumer discretionary, which are most exposed to economic and trade headwinds because their fortunes rise and fall sharply with the overall economy. Instead, investors were seeking refuge in more resilient areas of the market.
Okay, let's unpack this. If you look at the performance divergence among the S&P 500's 11 sectors, it actually provides a really clear, almost literal map of the market's newfound fears. It tells you exactly where the money was going and, more importantly, where it was running from, painting a picture of where investors see safety and where they see risk.
Exactly. Let's break down the worst performers first, because their struggles directly reflect those two primary catalysts we just discussed. The energy sector was the absolute clear laggard for the week. It's on track to report a staggering year-over-year earnings decline of 24% for the second quarter.
24%, that's huge. It's the largest drop of any sector. This poor performance is directly rooted in a significant 21% year-over-year decline in the average price of oil, which stood around $63 per barrel in Q2 2025 compared to over $80 in Q2 2024.
So lower oil prices were already hurting them.
Right. But then the weak jobs report and the escalating trade war amplified fears of a global economic slowdown, which would, of course, further depress demand for energy products and weigh heavily on future earnings, creating a double hit for the sector. It just piled on. Next up, healthcare came under intense selling pressure, particularly on Thursday. This happened after President Trump publicly issued letters to major pharmaceutical companies, explicitly demanding significant drug price cuts by the end of September.
Ah, the political pressure on drug pricing.
Yes, exactly. This direct political intervention introduced an immense degree of policy uncertainty. It's hard to value a company when its revenue streams are suddenly threatened by government mandate. This punished major industry players like United Health Group, Eli Lilly, Bristol-Myers Squibb, whose futures suddenly looked murky due to the looming threat of government price controls. UNH dropped 6.2% just on that news and weaker guidance. Then we have consumer discretionary. This is an economically sensitive sector, meaning it thrives when consumers are feeling good, spending freely on non-essentials like new cars, appliances, or dining out.
So if recession fears rise, these guys get hit.
Precisely. It was dragged lower by poor performance from key constituents, notably Amazon's post-earnings slump, which we'll dig into more in a moment, and a severe guidance cut from Whirlpool. Whirlpool explicitly cited tariff pressures as a reason for their cut, providing a textbook example of how trade policy directly disrupts business operations and corporate profitability for companies that rely on global supply chains or export markets. And finally, materials and industrials. These are highly cyclical sectors with significant global exposure. Think about companies that make steel, chemicals, or heavy machinery. Their business is intimately tied to global manufacturing and trade.
Right at the heart of the trade war concern.
Absolutely. They were truly at the epicenter of the week's negative catalysts. Concerns over a global manufacturing slowdown, greatly exacerbated by the new tariff regime, created powerful and immediate headwinds for these groups as their businesses rely heavily on international trade and consistent economic expansion. Any slowdown in global trade hits them directly and hard.
So those were the sectors investors were scrambling from. Now, where did they seek refuge? In a classic flight to safety, defensive sectors like consumer staples and utilities were the relative outperformers, right? Meaning they either gained or fell far less than the market.
That's right. They're non-cyclical business models. Think about it. People still need food, household goods, electricity, water, regardless of the economic climate, offer a stable haven for investors during periods of high uncertainty.
Predictable demand.
Predictable demand, often decent dividends. These sectors are seen as anchors in a storm, providing a sense of stability when other parts of the market are in chaos. And then we have information technology and communication services, which presented a much more complex picture. For the second quarter, these sectors were actually the leaders in earnings growth, largely driven by the colossal performance of what we call the Magnificent Seven companies, the tech giants. We're talking about incredible AI-driven earnings from those mega caps.
So the earnings were good, but they still got hit.
Yeah, because these are also high-valuation, high-growth sectors, and they were hit particularly hard in Friday's broad-based sell-off as investors rushed to take profits and reduce their overall risk exposure. Even if the underlying earnings had been strong, the general sentiment shifted to risk aversion, and these larger, highly valued names often see the most profit-taking in a downturn.
Sell the winners to reduce risk.
Exactly. Communication services, for example, had an estimated 29% Q2 blended earnings growth year over year, and information technology was at 19%. But that didn't save them from the broader market sentiment on Friday, proving that even fundamental strength can be overshadowed by macro fear.
To give you an even more granular view of how these macroeconomic themes played out, let's look at some key corporate movers. These individual stock movements really reflected the immediate impact of earnings, competitive dynamics, and of course, those brand new trade policies. The stories of individual companies give us a very direct look at the why it matters.
Definitely. On the losing side, Amazon, AMZN, shares plunged approximately 8% on Friday.
8% is a big move for Amazon.
It is. And this was a stark reaction, especially considering the company reported second quarter earnings and revenue that surpassed analyst expectations. So why the drop?
Yeah, what happened there?
The sell-off was attributed specifically to the performance of its Amazon Web Services, or AWS, cloud division. While AWS revenue growth of 18% was objectively strong, it failed to meet the market's increasingly lofty expectations, especially coming after rival Microsoft reported truly blowout cloud revenue figures earlier in the week.
Ah, the comparison game.
Exactly. This illustrates a critical point. The market is maturing on the AI investment theme. It's no longer just rewarding all players. Instead, it's intensely focused on competitive execution and is quickly punishing any perceived loss of market share or leadership in the crucial, high-stakes AI infrastructure space. It's a sign that perfection has got the expectation in that segment. Then there's Whirlpool, WRL. The home appliance maker stock spiraled down a massive 13.5%.
Ouch, 13.5%.
Yeah, after dramatically flashed its annual earnings forecast and even cut its dividend, the company explicitly cited pressure from rivals who were front-loading imports to get ahead of President Trump's tariffs.
So they were getting undercut by competitors trying to beat the tariffs.
That's what they claimed. It provides a textbook example of how trade policy directly disrupts business operations and corporate profitability, forcing companies to make painful decisions that impact shareholders immediately. It's not abstract. It's a real-world consequence. And United Parcel Service, UPS, plunged 10.5%.
UPS too, what was their issue?
They declined to issue annual forecasts. They linked their cautious stance directly to the uncertainty created by the administration's constantly shifting trade policies. It demonstrates the chilling effect of policy ambiguity on business planning. Companies hate uncertainty.
Yeah, hard to plan when the rules keep changing.
Precisely. And even Boeing. BA shares fell nearly 4.5% despite reporting a smaller than anticipated quarterly loss, showing investor skepticism about their turnaround prospects remains high.
But it wasn't all red arrows. There were some gainers, right? Some notable exceptions to the market carnage, which really highlight how specific company stories can still cut through.
Absolutely. First, solar, FSLR, for instance, emerged as one of the S&P 500's best-performing stocks. Its shares rallied after the company posted stronger than expected earnings and raised its full-year sales outlook.
So good old-fashioned earnings beat and raise.
Exactly. This proves that a compelling company-specific growth story, driven by solid fundamentals and a clear path forward, can at times actually buck a powerfully negative market trend. It's about fundamental performance shining through even when macro clouds gather. And earlier in the week, before the Friday chaos, Meta platforms, Meta and Microsoft MSFT had surged. Meta was up 11%, Microsoft up 4%.
Driven by those strong earnings you mentioned.
Yes, their quarterly reports absolutely crushed Wall Street estimates, driven by robust demand for their artificial intelligence offerings and pledges to accelerate AI capital expenditures. But crucially, even they surrendered portions of those strong gains on Friday during the broad sell-off.
So even the strongest performers felt the heat eventually.
Right. And one more notable mention, Figma, FIG, the design software company, made a spectacular stock market debut. Its shares soared a whopping 250% above their initial public offering price on day one.
Wow, 250%
Yeah.
in this market.
Yeah. This explosive IPO demonstrated that despite the growing macroeconomic concerns and the overall risk-off sentiment, a significant pocket of speculative appetite still remains within the market for unique, high-growth technology narratives. Investors are still hungry for that next big thing, if the story is compelling enough, showcasing that innovation can still draw capital even in uncertain times.
We've seen the sector and company level fallout. Now let's pull back and connect the dots at the macro level, because this week's economic data gave us what we're calling a tale of two tapes, a truly contradictory narrative that left investors scratching their heads. On the surface, the numbers seem to be telling two completely different stories about the U.S. economy, creating immense confusion.
Indeed. On one hand, we had the strong tape, the second quarter gross domestic product, or GDP, report. It showed the U.S. economy expanding at an impressive 3% annualized rate.
3% growth. That sounds pretty good.
It does. This handily beat consensus expectations of 2.3% to 2.4% and marked a sharp rebound from the down to 0.5% contraction we saw in the first quarter. On the surface, it looked like a robust recovery, suggesting underlying economic health. But on the other hand, we had the weak tape, that July jobs report, which we discussed earlier, pointing to a clear and rapid deceleration in the labor market.
So strong GDP looking back, weak jobs looking forward. How does that square?
Well, this divergence between strong, backward-looking GDP and weak, forward-looking employment data isn't necessarily a puzzle if you understand the underlying forces, and this is the crucial insight. Analysts quickly noted that the Q2 GDP figure was likely inflated by temporary factors.
Temporary factors like what?
These included swings in trade data and, critically, a pull forward of economic activity. What does that mean? It means businesses and consumers rushed to make purchases ahead of the anticipated implementation of new tariffs. They were essentially trying to beat the impending price increases, creating a temporary surge in activity that wouldn't necessarily be sustained.
So they bought stuff in Q2 because they feared it would cost more in Q3 due to tariffs.
Exactly. So the weak July jobs report is essentially the other side of that coin. It represents the subsequent slowdown once that front-loaded activity ceased. This view is strongly supported by analysis from the Budget Lab at Yale University, which projects that the new tariff regime will act as a significant drag on future GDP growth and employment.
So the Yale analysis confirms this idea.
It does. The data, therefore, suggests that the growth we saw in Q2 was not organic or sustainable. Instead, it was a policy-induced distortion, a fleeting rush of activity. And the payback, in the form of a weaker second half of the year, is now undeniably arriving, raising serious questions about the true underlying health of the economy.
This conflicting economic data really put the Federal Reserve in a tough spot, didn't it? They had just concluded their July policy meeting this week, holding interest rates steady, seemingly on a path of cautious observation.
Yeah, they were in wait-and-see mode.
But then that dismal jobs report landed just days later, completely upending the market's expectations. What's fascinating here is how it caused a dramatic repricing in interest rate futures markets. The implied probability of a rate cut at the Fed's September meeting surged from below 40% on Thursday to as high as 80% on Friday.
A massive jump in expectations.
Traders were suddenly convinced the central bank would be forced to act to support a faltering labor market, almost regardless of other factors.
The Fed's position is indeed incredibly difficult, akin to being caught between a rock and a hard place. Their path is complicated by the ongoing inflation outlook. While inflation has been relatively contained in some areas, the Personal Consumption Expenditures, or PCE, price index, which is the Fed's preferred gauge for inflation, remains stubbornly above their 2% target.
Still running hot.
Still running a bit hot. And crucially, the imposition of broad new tariffs creates a clear upside risk to inflation. Why? Because increased import costs will almost certainly be passed on to consumers, pushing prices higher.
So slowing growth and potential for higher inflation from tariffs, that's stagflationary, isn't it?
It presents a potential stagflationary dilemma for policymakers.
Exactly.
They face the unenviable choice of combating rising unemployment by cutting rates, potentially fueling inflation, or fighting persistent inflation, which could further dampen economic growth. It's a terrible trade-off. Adding another layer of complexity, President Trump has publicly renewed his demands for the Fed to cut rates, injecting a direct political dimension into the central bank's deliberations, which are supposed to be independent.
Right, the political pressure's back on.
It is. All eyes will now turn to the Fed's annual symposium in Jackson Hole, Wyoming, in late August for potential signals on its future policy path. That will be a critical event for clarity, or perhaps for more uncertainty.
And as we touched on earlier, the week's defining event, the true geopolitical earthquake, was the formal announcement of that new U.S. trade policy. It represents a significant and, frankly, aggressive escalation of global trade tensions. The executive order signed by President Trump imposes tariffs ranging from 10% to a staggering 41% on dozens of countries.
It's a huge move.
This effectively raises the average U.S. tariff rate to 18.3%, a level we haven't seen since the infamous Smoot-Hawley era of the 1930s, a period widely associated with exacerbating the Great Depression through protectionist trade policies. The historical echoes there are certainly unsettling. This new regime creates very clear winners and losers, both internationally and domestically. While deals were finalized with the European Union at 15%, the UK at 10%, and South Korea at 15% rates that were somewhat priced in, other key partners were hit with much, much higher rates.
Yeah, some got hit really hard.
Canada, for instance, faces a whopping 35% tariff on certain goods. India was hit with a new 25% tariff, and South Africa received a 30% tariff. Interestingly, Mexico and China both received extensions for their ongoing separate negotiations, which offered maybe a sliver of hope in an otherwise grim trade picture, suggesting a more strategic, albeit still unpredictable, approach for these specific larger partners.
Perhaps. Or maybe just delaying the inevitable confrontation. It's hard to say for sure. To put a quantitative framework around the potential consequences of this aggressive policy shift, we can look back to that economic impact analysis conducted by the Budget Lab at Yale University. Their study projects that the full suite of 2025 tariffs will have several significant effects on the U.S. economy. First, it's expected to reduce U.S. real GDP growth by 0.5 percentage points in both 2025 and 2026.
0.5% off GDP growth, that's substantial.
It is. For an economy the size of the U.S., that means billions of dollars in lost economic activity, a direct hit to the overall size of the economic pie. Second, it's projected to increase the unemployment rate by 0.3 percentage points by the end of 2025, meaning hundreds of thousands more Americans could be out of work than otherwise would be.
More job losses on top of the weak July report.
Potentially, yes.
Okay.
Third, and critically for every household, it's expected to raise the overall consumer price level by 1.8% in the short run. To put that into relatable terms, that translates to an average annual cost of $2,400 per U.S. household in higher prices.
$2,400 extra per year. Ouch.
Yeah. And for specific consumer goods, we're talking about really sharp price increases. A projected 40% rise for shoes, 38% for apparel, and 12% for motor vehicles. These are not minor adjustments. These are significant direct impacts on your wallet. Now, this policy isn't a uniform drag on the entire economy. Instead, it reshuffles economic activity in somewhat complex ways. The Yale analysis projects that while the overall economy contracts, domestic U.S. manufacturing output could actually expand by 2.1% in the long run due to protection from foreign competition.
So some manufacturers might benefit.
That's the theory, the intended benefit for a specific segment. However, this gain is projected to be more than offset by contractions in other larger sectors, such as construction, which is expected to shrink by 3.5%, and agriculture, which could contract by 0.9%. This illustrates a very targeted, though broadly impactful, reallocation of resources, where gains in one area are more than negated by losses elsewhere. This divergence is also keenly evident within the equity market itself. A recent report from J.P. Morgan highlights that large-cap stocks, as represented by the S&P 500, have significantly outperformed their small-cap counterparts in the S&P 600 this year.
Large beating small. We've seen that thing.
Exactly. And this gap widened even further as tariff concerns grew. Why this disparity? Small-cap companies are fundamentally more vulnerable to these tariffs.
How so?
Well, they often have a greater reliance on single import partners, like China, for their supply chains, making them less agile. They typically have a more limited ability to quickly reconfigure those supply chains when tariffs hit, unlike larger corporations with vast global networks. And crucially, they often have lower pricing power to pass on increased costs to consumers. They simply can't absorb the tariffs as easily as larger, more diversified corporations.
Makes sense. Less wiggle room.
Precisely. This performance disparity between large and small firms and between protected and exposed sectors is likely to be a durable investment theme as long as this aggressive tariff regime remains in place. This isn't just a fleeting trend. It's likely a structural shift that investors need to carefully consider.
This dual shock from the U.S., both the disappointing jobs report and the unexpectedly aggressive tariffs, didn't stay contained within U.S. borders, did it? It sent powerful negative ripples across global financial markets, triggering widespread declines as investors worldwide rapidly reassessed the outlook for global growth and trade. It was a true contagion event.
Absolutely. Looking at the performance of key international indices, European bourses ended the week sharply lower. The UK's FTSE 100 fell 0.6%. It was weighed down not only by the global risk-off sentiment, but also by specific pressure on its heavily weighted pharmaceutical stocks, like GSK and AstraZeneca.
Right, because of the U.S. drug pricing pressure.
Exactly. That had international ripples, too. Germany's DAX index, often considered the economic engine of Europe, was one of the worst-hit major indices globally, plummeting a significant 3.82% for the week.
Wow, nearly 4% down in Germany.
Yeah. As the benchmark for a heavily export-reliant economy, the DAX is acutely sensitive to global trade tensions and the prospect of a U.S. economic slowdown, making it particularly vulnerable to the week's news flow. Asian markets also felt the pressure. Japan's Nikkei 225 declined 1.58% for the week. This was dragged down by the broad tariff news and notably a steep 18% plunge in chip-making equipment giant Tokyo Electron.
18%? What happened there?
They slashed their profit forecast, citing changes in spending plans by semiconductor companies. It illustrates the interconnectedness of global supply chains. A slowdown in chip investment in one part of the world impacts suppliers in another.
The ripple effect in action.
Precisely. China's Shanghai Composite was, interestingly, more resilient, falling just 0.2% on Friday. Investors there seemed to hold out hope that the extension of U.S.-China trade talks would lead to a more favorable outcome, somewhat insulating it from the immediate impact of the broader tariff regime.
Holding out hope for the China talks.
Yeah, but the reaction in India, however, was more direct and severe. The BSE Sensex tumbled 586 points, or 0.72% on Friday, reacting immediately and viscerally to the U.S., confirming that 25% tariff on Indian goods, a move that directly targeted the country's key export-oriented sectors. It was an immediate, palpable hit to their market.
So that was the turbulent week that was, a true pivot point for the markets. But now let's turn our attention to the week ahead and start anticipating tomorrow's market. What key economic data releases and significant events are on the horizon that could further shape this volatile and now much more uncertain landscape? Because what happened this week will definitely spill over. First up, on Tuesday, August 5th, we'll see the release of global services PMIs, right? The Purchasing Managers Index data for services sectors worldwide.
Yes, those will be key.
After manufacturing PMIs showed deteriorating conditions last month, these reports will be absolutely crucial for assessing the resilience of the global economy, particularly the more domestically focused services side. A particularly robust U.S. ISM services PMI reading, for example, could further complicate the Federal Reserve's policy calculus by suggesting underlying strength in one part of the economy, even as the labor market appears to weaken.
More conflicting data for the Fed, potentially.
Could be. Then, on Thursday, August 7th, we have the Bank of England rate decision. The BOE is widely expected to deliver a 25 basis point rate cut, bringing its benchmark rate to 4.0%.
Yeah, the cut seems likely.
However, with UK inflation remaining stubbornly above target, the decision may not be unanimous, right? Any hawkish dissent members arguing against a cut could certainly influence trading in sterling and UK assets.
Definitely something to watch in the voting pattern.
Other data points to watch include U.S. factory orders and international trade data, as well as key employment reports from Canada and New Zealand, all contributing to the global economic picture.
As investors navigate this newly uncertain environment, several dominant themes will continue to command intense attention and will dictate market movements. First, there's the ongoing tariff fallout and negotiation. With the new, broad U.S. tariffs set to be formally implemented on August 7th, the market will be on incredibly high alert for any last-minute negotiations that could soften their impact, any retaliatory measures from affected countries, or further policy clarifications from the White House that could shift expectations.
So headline risk remains very high.
Extremely high. And the separate U.S.-China trade talks, which have that August 12th deadline, remain a critical and profoundly unpredictable wild card for global markets. Any news, or even a lack of news, from that front will be highly impactful and could trigger significant swings. Second, the Fed's next move will be under intense scrutiny. The market has now aggressively priced in a September rate cut, making every incoming data point and every public comment from a Federal Reserve official a potential market-moving event.
Everyone hanging on every word from the Fed.
Pretty much. The minutes from the July FOMC meeting, released in the coming week, and any speeches by Fed governors will be scrutinized for any clues regarding the central bank's reaction to the conflicting growth and employment data. And as we mentioned, the Fed's annual Jackson Hole Symposium later in August is now circled as the key event for a major policy signal. A lot of expectations building for that. Third, while the peak of the Q2 earnings season has passed, earnings season winds down. Reports will continue, but the focus will decidedly shift from the backward-looking results themselves to corporate guidance for the third and fourth quarters.
What are companies saying about the future?
Exactly. Investors will be listening intently for management commentary on the expected impact of the new tariffs, the slowing economy, and shifting consumer behavior on future profitability. This guidance will be far more important than the backward-looking numbers, as it provides a window into how companies are actually planning for the new, tougher environment. Finally, the recession watch will intensify dramatically. Following the weak July jobs report and the escalating trade war, the debate over whether the U.S. economy is heading for a recession will become even more fervent and widespread.
The R word is definitely back in the conversation.
Oh, absolutely. Key forward-looking indicators, including the shape of the Treasury yield curve specifically, whether it inverts further, a historical predictor of recession corporate credit spreads, which measure the perceived risk of corporate defaults, and weekly jobless claims, which offer a real-time pulse on the labor market, will all be monitored with heightened vigilance for any further signs of deterioration. These are the indicators that often flash red before a downturn, and everyone will be watching them like a hawk. So, to offer a concluding strategic view, it's clear the market has decisively shifted. We've moved from a period of calm, steady gains into a new phase defined by heightened uncertainty and volatility. The Goldilocks narrative, that comfortable belief in a resiliently growing economy that would soon benefit from benevolent Fed rate cuts, has been shattered by the stark reality of a weakening labor market and an escalating global trade war.
Yeah, Goldilocks has left the building, it seems.
It seems so. The prevailing trend has pivoted from a low-volatility upward climb to a much more defensive, unpredictable, and frankly challenging investment environment. This isn't just a bump in the road. It feels like a fundamental re-rating of risk.
So what does this all mean for you, the listener, in practical terms? Well, it implies a very real strategic adjustment for your portfolio. Those tactical pullbacks, which were confidently viewed as automatic buying opportunities just a week ago, now carry significantly more risk. Buying the dip just got harder.
Much harder, much riskier.
The path forward will likely be driven less by beta, simply riding the market's overall upward trend, and much more by alpha, that outperformance you can achieve through careful individual stock picking. This means emphasizing quality and diversification. Think about companies with strong balance sheets, those with durable competitive advantages, and firms with demonstrable pricing power, meaning they can pass on higher costs without losing customers. These are the companies best equipped to navigate both macroeconomic headwinds and the margin pressure created by unpredictable policy uncertainty.
Exactly. The performance divergences that became so apparent this week between large caps and small caps, and crucially, between tariff-resilient and tariff-exposed sectors, are not fleeting anomalies. They are likely to persist and should be a central consideration in all your asset allocation decisions moving forward. Understanding these fault lines in the market is key to navigating what promises to be a complex environment.
Which brings us to a final thought to leave you with. Considering this dramatic swing, if policy-induced distortions can inflate GDP numbers only to bring a payback in jobs and consumer costs, what does this tell us about the true underlying health of an economy in an era of unpredictable trade policy? And perhaps more importantly, how do we as investors and informed citizens learn to differentiate between temporary market jitters and a fundamental long-term shift in the global economic landscape, especially when so much seems driven by unexpected policy moves? It's a question worth pondering as we navigate these dynamic shifts.